Hey guys, it's Cam for Investors Underground. Welcome to lesson 4 of 8 of the Intermediate series on YouTube. And what a great series this is turning out to be. Although the release schedule is a little bit slower than we originally anticipated, I really feel like we're delivering on the quality of content, and today's lesson is no exception. We've got a jam-packed hour for you guys discussing the mechanics of a move in the market. We go through some of the theory, some of the practical, use examples and chart references to have a look at some of the telltale signs before a stock might make a big move. This is really an area of Nate's expertise. He's one of the best in the world at reading inflection points and general sentiment around different stocks and sectors. So he's going to be doing most of the heavy lifting on this lesson, but I'm going to give you guys a little bit of an intro to get everyone situated and ready to roll.
Guys, before Cam gets going into what it takes to be a trader this year and why things are as crazy as they are, I just wanted to take a quick minute before, I take the mic a little bit later on to just remind you that, this is all about absorbing as much information as you can and finding out the type of trader that you are. Not everybody is the same trader. Everybody is a make of many, many, many different types of traders, right? Everybody takes a little bit from every different person and really molds into the best trader that they can be that fits their own personality. What works for me may not work for somebody else. What works for your friend may not work for you. But what is important is to be able to take a little bit from everybody and then make your toolkit better, right? So I would encourage you guys to really take time, take notes. I would encourage you guys to reach out. If you guys have any questions whatsoever, we're always here to help. I hope that you guys find value in it. I hope that you guys are having a wonderful year. And if you're not, it's really okay, because it all starts somewhere, and that could potentially be today. It's all about having a proper process. It's all about having a proper plan. And you know what? It's also about having realistic expectations. And if you're misaligned in any way, then you're going to veer off course. So it's really about fine-tuning what your goals are, staying on course, becoming a better you, and always focusing on process. With that, I'll turn it over to Cam. I'll see you guys in a little bit. Enjoy.
So the last time we did one of the intermediate lessons was around 6 months ago. And at that time of year, the coronavirus was really unfolding and we were seeing a lot of market volatility surrounding it. We're also seeing a big trend towards work from home and the effect that that had on increased number of market participants. And back then we said, the opportunities were really presenting themselves on a daily basis. We thought that things couldn't get any crazier or any better. But 6 months later, wow, what a time to be a trader. So today's webinar is going to be hosted by myself and Nate. I've been involved in the markets for approximately 12 years now and helping Nate run the Investors Underground community for over a decade. 2020 will mark the 17th year Nate's been trading full-time, and it's also his very best year trading from not only a making money perspective, but also consistency and really sizing into A+ setups that we seem to be seeing on a daily basis at the moment. Which brings me to my next slide. What a year to be a trader. Every day we come to the market fully prepared, waking up early to capitalize on the insane amounts of opportunity that the market is presenting us on a day-to-day basis. We've had so many longer-term members of Investors Underground reach out to us, the familiar faces, and tell us that they've done a 5x or a 10x of what their normal trading year might normally look like. It's been a career-defining year for so many of the Investors Underground members. 2020 really feels like it's presented us with the opportunity to make a whole lifetime of gains in a single year of trading. So the next pointer I've got here is, will it stop? Is it going to end? And from everything that we're looking at, I believe that 2021 is going to be a continuation of the trend, if not an even bigger year than 2020. And I'm going to dig a little deeper into the why of that during the lesson. So as I mentioned, a lot of the old faces in Investors Underground are having a killer year. But it really is great to see that there are so many new faces coming on board who have been energized and activated by the market in 2020, discovering the market maybe as they were working from home during the pandemic, learning about what it might take to become a successful trader, and starting to carve their own path through the volatility and the opportunities in the markets, learning and gaining experience along the way. So why should you be interested in what we've got to say for the next hour? Why should you care? Well, we believe that right now is a very unique time in history, where you have a combination of market-related events that are creating volatility, added with a huge increase of market participants, which create liquidity during a time where you might be able to explore the world of trading because your circumstance allows you to dedicate a little more time to it. For these three reasons, the volatility, the liquidity, and your own circumstances allowing you to dedicate energy and time towards this opportunity, we've never seen a better time for people who are currently trading now, and we've never seen a better time for people who are looking to start trading. So I can hear collectively people screaming at their screens. Why am I listening to this guy? Why don't I just start firing trades, clicking buttons, or stacking up size, and make a heavy move into the market? Well, as you'd know if you have been through the beginner series and the first 3 intermediate series that we put out, while the barriers to entry of the trading world are very low, virtually anyone can open up a brokerage account if they've got money and a couple of forms of ID. This doesn't mean that you're going to be successful in the markets. The most important thing is having an edge. And we've explored a lot of that through the content that we put out on a weekly basis with Nate's Sunday Scans, and also all the free lessons that we put out on the YouTube channel. And we hone in and develop our own edge in the market and help teach that to all of the Investors Underground members so that they can understand how and why we do things and take the pieces that they believe will help them in their own trading. So the meat of today's lesson is going to investigate some of the market mechanics around how and why big moves take place, some of the telltale signs that a big run is starting to unfold, with the specific attention of float rotation. So as you guys already know, our approach to both trading and teaching is very methodical. When it comes to teaching, we like to look at things from a theoretical perspective so that traders can understand the why. Then we look at it from a practical perspective so traders can understand the how. And then we use examples so that people can integrate these lessons into something that they can use on a daily basis with pattern recognition and chart explanations to go along with the why and the how. So the term float rotation is an Investors Underground term that Nate personally coined probably around a decade ago. And while it was an important concept through his trading career, the idea of it has become much more important and much more in play in recent times versus in the past. So we've got millions of new traders, millions of new market participants who are bringing in money from the sidelines that were never involved in the stock market before. But roughly speaking, we've got the same amount of stocks. Sure, there's been a couple of new listings, a few IPOs, and some secondaries to maybe increase some of the supply. But this is marginal compared to how many new people are trying to play this game. So I've got here that day trading is the new contact sport of the decade. 2020 has ushered in this new adrenaline-filled pastime where people haven't been allowed to be outside competing in their normal activities or betting on the sports that they would normally watch during normal seasons. And individuals have been seeking that rush, that competitiveness, that adrenaline hit that can be produced from something like the stock market. So as I was saying, there's millions of new people who are trying to do this for whatever reason it is. I've got my own theories behind it, but I think a big one of the reasons is there's a brand new pool of work from home crowd. And it's my belief that although the initial surge of market participants was because of a temporary work from home measure to try and flatten the curve and reduce the initial spread of coronavirus, I believe that there's a structural shift going on where individuals will be able to have more flexible work schedules, where a certain percentage of people will be able to work from home for a certain percentage of time, and on a different PC or tablet, they'll be able to participate in the markets without their boss really looking over their shoulder. I believe that although, in future years, obviously the pandemic will become less of a thing, I believe the shift to work from home in one form or another is here to stay. And I think that during the start of the pandemic, where all professional sport was cancelled, a lot of people turned to the stock market to get their fix as the sportsbook was closed. But now as a structural shift, in the same way that you might bet on your favorite team, you might bet on your favorite company now as well or instead. And the last pointer I've got here, money is free. And that might be a little bit crazy to say, but we're going to explore this on the next slide. So what exactly do I mean by money is free? Well, interest rates are at 0%. So if you've got money in the bank, it's not earning you anything. And if you're creditworthy, it's very, very cheap to get debt. The second point here I've got is individuals got a direct cash injection from the government, but more significantly, there's been a pretty heavy helicopter money stimulus for small to medium businesses. With small businesses getting 6 figures and medium to large businesses getting 6 to 7 figures, depending on the number of employees you've got and your payroll and your size of revenues, that kind of stuff. All that money has come down in the form of stimulus, and it needs to find a home somewhere. Many people have opted to take advantage of an offer from their banks to defer their mortgage repayments for, 6, 9, or 12 months. This is an effort from the bank to stop delinquencies and avoid another 2008-2009 situation. But I think a lot of people who qualified for the mortgage deferral actually haven't taken a huge hit to their cash flow of the household. So let's say they were making, $10,000 a month before. They might be making $7,000 or $8,000 a month now, so they've taken a 20 to 30% hit on their household income. But suddenly they don't have a $4,000 or $5,000 mortgage repayment per month to take care of. At the end of a few months, they've got an extra $20,000 that used to be committed to paying off the mortgage that they have in free cash that's also looking for a home. So at the beginning of this whole pandemic, it was my belief that discretionary spending would be shredded and the consumer would go into retreat. And this is probably one of the predictions I got the most wrong. I'm glad I didn't make a big bet on this because I was sure that with the reduced income that households were experiencing with increased unemployment, the consumer would go into retreat, discretionary spending would take a big hit, and things like cars, boats, bikes, RVs, toys like that, we'd be seeing a fire sale so that households could generate some revenue to make good on other commitments that are more important. Well, the exact opposite happened. People who were spending more time at home were doing more online shopping. People who were bored and wanted to, regain a portion of their lifestyle were buying lifestyle products like boats and trail bikes. Stuff that they could use during the pandemic that were somewhat socially distanced. You go out on a boat and you go fishing with a couple of buddies. There weren't as many restrictions placed on stuff like that than there was going for beers at the pub with your mates. So while I thought it'd be a great time to have some cash on the sidelines ready to deploy when toys got cheap, I was eyeing off all of the things that I was ready to buy when stuff was 30% off, 40% off maybe. All of this stuff became more expensive. So whether it's a case of it hasn't really flowed through to this stuff yet, or whether it's a case of people making a lifestyle decision like buying an RV and traveling around the US instead of going on that European holiday, the consumer has not gone into retreat. And you can see this with, something like Peloton. Historically, people would spend $50 or $70 a month on their gym membership. However, in the interest of staying fit and being able to exercise from home, people are spending thousands of dollars on a new Peloton bike. The stock has gone crazy, their revenues are up huge, and it just goes to show that people in the US still have money to burn. I think another thing at play is there's a bit of a YOLO effect going on. And for those who aren't in Gen Y or Gen Z, YOLO is an acronym for You Only Live Once. And during 2020, I think it highlighted to people the fragility of life. And a lot of the plans or a lot of the goals that people had sitting on the shelf got put into play this year, whether it was a goal to get fit or to pursue a hobby like kayaking or to travel around the US, like I said, in an RV. People got the feeling, hey, life's short, and I believe it brought forward a lot of future demand because people want to live now and in the moment versus planning for the future. So this is a little bit more subjective than stuff we'd normally talk about, but I wanted to give my hot take on what I think's going on with the consumer at the moment, in my personal opinion. So what effect does all this have on the stock market? What is the effect of discretionary spending on the stock market? Well, I believe that the stimulus meant that a lot of people had extra money to dabble. People whose income wasn't affected at all by the pandemic, in many instances still received a significant amount of stimulus, and that money needed to find a home. The other pointer is, with interest rates axed to 0%, people are putting lazy money to work. They look at the stock market going crazy every day, and they figure they'll try their hand to see if they can make more than 0.000% in a term deposit. And with market participation at all-time highs, there's so much fresh money flowing into the market, it's no wonder we're seeing what we're seeing today in terms of action. So to kind of put a bow on that, there are millions of new traders, the same amount of stocks. It creates different dynamics within the supply and demand of the overall market or even certain tickers. When you've got huge volume, especially on the hot tickers of that day or week, but you've got the same inventory, you can see moves of 500, 1,000, sometimes even 5,000%. So how do you predict these moves? How do you know when something might be explosive? So in this lesson, we're going to be focusing on what makes up the mechanics of a move. And this year we've seen many moves in a variety of different tickers and sectors. We've seen it in the work from home sector. We've seen it in the pharmaceutical and vaccine sector. We've seen it in the airline and hospitality travel sector. And we're going to be focusing on the concept of float rotation, volume, availability of borrowers, halts, and looking at whether price action is above or under a key level. Now, obviously, this is quite a lot of subject matter to try and cover, and this is the stuff that we go into detail pretty much every day with Investors Underground members. But we're going to give you a brief overview so you get a bit of a feeling of what we're looking for when we see one of these outlier moves or formal runners get ready and go. What are the actual mechanics? What are the pieces? What's the process that we look at when inspecting this for a trade? So I'm going to open up the old MS Paint. And for any of you guys that are familiar with some of the tutorials that we do here, sometimes old school is best. So I'm going to attempt to explain a concept called float rotation. I'm just going to do a little bit of an intro on it, but Nate's the pro at this, so he's going to go into a little more depth after I get going. But let's say we've got a company XYZ, and the float is 10 million shares, and on average, roughly every day it trades maybe 100,000 shares. But let's say in the pre-market, it's gapping up because there's been some kind of news or catalyst overnight. And in the first 15 or 20 minutes of the day, it's already traded abnormal volume. It's already traded 1 million shares. Well, we'd look at this and we'd think, this might be a stock that will be in play today. It's already traded 1/10 of its float and 10 times its average volume in a mere space of minutes. It's definitely one to keep an eye on. So I'll mark in 930 with this green dotted line here. It's already traded a tenth of its volume, and now it's starting to get momentum. So it pushes into the open and has a little pullback. And this is again on much higher than normal volume. This time, the volume comes in, we get a spike as it rolls over as well, and all of this volume is 2 million shares this time. So let's say this is a $3 stock to start with, and it ran up to 4 and maybe 5 up here. Well, some of these 2 million shares are going to be sells of the previous million who got in early. So during this little pullback, this was on quite a lot of volume. So that might be shaking out people from the $3 area as well. They might be selling out there. But let's say this stock continues to go up and it has a nice big spike, goes sideways a little and keeps on going. And all of this is on very high volume again. This time on much higher volume than before, maybe 6 million shares. Well, some people would have shorted during this pullback and they're taking their loss over here. That creates volume. Those are some of the players. Some people who bought here are selling into this push. And like I said, that was on 6 million shares traded, so really high volume during that move. Well, let's say this chart then goes sideways a little bit and has a massive pullback and bounces and consolidates. And all of this happens on even higher volume. The big spike is when it pulled back, and all of this was maybe, let's say, 10 million shares volume. Well, you got all sorts of things going on during this move. Maybe people who bought here got flushed out here and scared. Maybe some people who were dabbling here and here also kind of just got out of the way. And maybe you got some short sellers involved on that pullback who thought, hey, the trend's broken and this thing's over, only to get trapped when it spikes back up. At this stage, it's maybe 11 a.m. and it's traded 19 million shares, just under twice its float. A lot of people from the lower prices have rotated out into people who might own it, waiting for the next move up. A lot of people who thought it had gone too far got involved short, especially during those pullbacks, only to get trapped, potentially with an algo buying those dips. And as it perks back up, maybe the algo is taking from the offer, walking it up, ready to squeeze the stock higher at the expense of the shorts. The shares rotating over and over means it's less about the price per share and more about the volume and the moves, looking at levels, working out who the players are, where their maximum pain is, and anticipating what the momentum will do moving forward based on your understanding of how this all works. So Nate's too humble and modest to say something like this, but I believe that he's one of the best in the world at reading the markers, analyzing all of these variables to predict these outlier moves, not only when they're about to run, but also when they're running out of steam. So I'm going to hand over him to get started with float rotation, given that he coined the term and is one of the leading experts in the subject matter. Thanks, Nate.
Thanks so much, Cam. Yes, float rotation is one of the most important things to understand if you're a small cap trader. I'm going to go through a very dimmed down version of it just because we don't want to keep you here all night. However, the concept is basically the idea that we're taking a lot of shares in a few hands and dispersing it amongst many different hands. So the idea is, for example, if there's a float of 5 million shares and there is about 1,000 shareholders, everybody would maybe have about 5,000 shares. If the float rotates a few times, meaning If it trades 5 million shares, then it starts to trade 10 million shares on the day, maybe 15. There's a good chance, you could probably safely assume, that the shareholder count is going to go up. So now if you have 2,000 shareholders, on average, every shareholder may own about 2,500 shares of stock. Flip a few more times, maybe it gets to 30 million shares on the day, 35 million shares. Maybe at this point you now have 5,000 shareholders, and on average the shareholder owns about 1,000 shares of stock. So, this might be a very simple number. Usually I would assume that it is probably much higher, maybe tens of thousands of shareholders, especially in this day and age. But you spread it out amongst many, 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 many shareholders, and all of a sudden the supply is absorbed. So it all comes down to supply and demand. It all comes down to how much is available. I always say that volume trumps all, right? So if there's only 5 million shares out there, and there's always, different things fundamentally that you could potentially find out more. That's for another conversation. So sometimes, maybe there's 5 million shares now, but it could turn into 7 or 10 or 20. But like I said, that's another conversation. This concept is just about understanding, one, how you could identify a potential runner, and two, I think most importantly, if you're a short seller, how you can stay away from a potential trap, and what should make your antenna go up to say, hey, I should probably be careful on this one. It's pretty simple. Volume, right? And so anytime there might be news or a sector run or a name that has ran before, and this type of action comes and goes in the market. Sometimes small caps are super, super hot, and they're trading hundreds of millions of shares per day. And then other times we have weeks where we might be lucky to have one runner. Fortunately, we haven't had that problem in 2020. And most of 2019, I would say, either. But typically, we look for volume. So in the morning, if you've got a small cap runner and it's up, let's just say 20, 30, 50, 100%, all I care about is volume. I'm watching the volume. And if the volume's trading a million, 2 million shares, then it quickly goes to 5 million shares. Then we're already at 10 million shares by the time 9 a.m. arrives. Then I know we have a potential player. And so the ones that in this situation that I would consider for the long side is when that trend holds. Typically you might see a lot of volume, and then it fails. And then what I call failed follow through momentum, where it kind of ramps up, it fails, then it pulls back some, tries again to break out, it fails, then it pulls back some, and so on and so forth, and we have a nice, full day style fade. However, on the flip side, what happens if the volume continues to compound? What happens if it keeps on cycling over and over and over again, and the trend holds? What happens if, it's going up and then high or low, ramps up, high or low, and each time that it does maybe fail or take a break or look like it's going to pull back, it hangs on, right? Those are the ones that I'm talking about. Those are the ones that are potential long side trades. And what happens is people look at the price. They say, oh man, this thing's up 50%, 100%. It should pull back. And so shorts start to come into these particular trades, not really paying attention to the volume, which is potentially outlier volume for that given day. And they start to make decisions based off of price and percentage moves and things like that. And what happens is if the float is continually churning and the shareholder base is continually growing and shorts come in and they decide they're going to short, they get on the wrong side of the trade, they add, get on the wrong side of the trade some more, they add. Their short position is growing while everybody else's position is getting smaller and smaller and smaller. So now instead of one person deciding they're going to sell and all of a sudden, stock goes down, now you've got to have, thousands of people all decide to sell at the same time in order for, you not to move the price when you try to cover a particular stock. It's all about supply and demand right now. And what's happening is these algorithms are coming into these particular names, churning the volume, creating this just major liquidity environment. And, people are buying because it's working and holding. And so now the demand is just so high and the supply is limited. And it's limited to what's out there, what's in the public float, plus potential shorts. So then shorts come in and they're adding to this supply, but the price is not going down. If the demand is too high and the price won't pull back, then at some point, shorts will have to unwind that position. The only way that they can unwind that position is by buying, bidding, trying to buy back that position for the cheapest price possible, basically. And so when that starts to happen, especially in 2020, on these thin names with high volume, a lot of times you have what we call swipes, one big move that just swipes the stock up. Sometimes you have circuit halts when they have moved a percentage within a 5-minute period and it does a volatility pause. It takes a little bit of a break for 5 minutes. And sometimes that will cause the emotional panic from the short side and starts to compound the issue. And guess what? We're going circuit halt to circuit halt to circuit halt, and shorts get ran over. So that is one way to benefit from float rotation and being on the right side of the trade. The other way, from a short perspective, is just not knowing, what is it tracking for? What is it tracking for off the open? If something is tracking to trade 10, 15, 20 million shares and it's a super thin float, you need to be hands off. You need to be cautious. It's okay to trade it, but you need to be aware. And if you're fighting that name, it's not going to end well. So, most important part is volume. Most important part is trend. Making sure that the trend is holding. And every single time that a particular trade should have pulled back but doesn't, that is a point at which it could just be getting stronger and stronger and stronger. Because as you guys know, the best short squeezes come by surprise. And when something should have died, something should have pulled back, and it doesn't, well, you're probably not the only one that thinks that. And there's probably a lot of other shorts that are on the same side as your thought process. So when that happens and it should have pulled back and it doesn't, and then it swipes up to the next level and it consolidates, it's hanging around, and then it starts to pull back, but it goes right back up, that's when shorts are going to start to compete on the bids, compete on the offers, and try to unwind their position. But like I said, as the float rotates, now there might not be that amount of shares on the offer for them to cover back without moving the price up quickly, because the float is being dispersed amongst many, many shareholders. It's spreading out. All these people are now holding instead of flipping like most of the active traders. So throughout the day, the actual float that's being churned back and forth is actually becoming smaller and smaller and smaller and smaller, because you've got all the buy and hold type of traders taking a little bit here and there and absorbing the float. So that is the concept of float rotation. It's extremely important, especially in 2020, because what's happening is we have these main players, and I always say they. They refers to any main players, basically influencing the price. Maybe one or two main players, maybe a main player that has an algorithm that is trading a stock in and out, creating this liquid environment, right? So to bring this all together, the what, the why, the how about this float rotation, different circumstances that it occurs, and how it plays out, I think that the best way will be to do some chart examples. So I will go over some chart examples to show you guys what you could kind of expect to see. I think that one of the biggest changes in 2020, or since we did the last State of the Market webinar, is just the number of traders that are out there. I don't remember the numbers specifically, but between E-Trade and Schwab and Morgan Stanley and all those different brokerages, I believe it was somewhere in, 6 million accounts or something like that within the first quarter of 2020 that were new, which when you think about it, that's an insane number of retail traders. Now, maybe they don't all do what we do, obviously. But the point here is that they are the people that will come in and they will be buying 100 shares of this and 500 of that. And they're not flipping it out 1 minute later. So that is the concept. They're soaking that float. And as the volume rotates and rotates and rotates and rotates, they're not sellers. So that is why some of these trades work. And when we have this outlier volume, we have outlier situations, which you will see on a couple particular trades, which give both a great trade to the upside, but also to the downside. The thing is, though, is you don't want to be too early trying to find the backside. So again, the number of traders, the number of players is at an all-time high ever since, like Cam said earlier, with the pandemic and people at home, they've become traders. They see other people making money. There's no gambling, you name it. And everybody has been rewarded for buying and holding. And for the most part, it's actually worked, right? So if you have been trained to just buy and hold, that's what you're doing. And so as the volume picks up, day traders like myself and others, there's less and less shares that are out there that you're competing for. And what happens based off supply and demand is that the price then ends up going up. So again, that is the concept of float rotation. We're going to move into some visual ideas and examples. But I would also say that, there's a whole nother concept to understanding this, where it's not every name created equal, right? Sometimes there are companies that are pending offerings. Sometimes they have filings where they can sell stock. So with that said, sometimes when there's heavy volume and it's not holding the trend like I talked about, and it's failing to follow through, lower highs, people might look at the volume and think float rotation, but they don't actually understand that the trend is failing. So the key concept here with when float rotation matters is when the trend is actually holding, when things are moving higher, when stocks are acting trappy, and shorts are on the wrong side of the trade. So GTech is a recent example of a float rotation play, but what I want to do is take a look at the intraday chart. So in order to do that, obviously we need to go back to the day that it ran, and that's going to be about a couple weeks ago. So you can see here that we had a decent amount of volume that had already started up in the morning, and kind of ramped up on a bunch of volume, and it continued to go up to about 5, and then it just sort of faded off. And keep in mind, this only had about 1 million, maybe 1 million, 1.2 million float, something like that. So here we are, and we had traded already millions of shares. But then also on the downside, it gave shorts the confidence that they were on the right side of the trade. It continued to go lower. It continued to prove them right. But then we hit a level of support. So that's typical. Usually you'll have a little bit of a rebound at some point, right? It's going to unwind, and then we have a little bit of a rebound. And then what happens next is what matters, right? Do we stuff into prior resistance and then we start to unwind, or do we break down? So in this case, it ramps up starts to consolidate a little bit, failed follow through, comes back and retests that same exact level again, and it doesn't break. This time they absorb it. So now shorts are left with a decision. Do I be patient, which has worked all morning? I'm styling, I'm doing great. Or do I cover? And so this is what we were talking about, where there's only so many shares that are available. And as it spreads out and out and out and out, what can you do? So the entire morning, they pretty much rotated the float around and around and around and around, created the appearance that shorts were doing the right thing, created the appearance that it was going to fail. And then swiped out of the open, consolidated. You can see all the dips were soaked up. And then away we went. We were right back up to the highs in only a few candles. So at this point, shorts were stuck. And so what you can see here as well is when it blows off, when it squeezes everybody out, flushes out. It comes back, slams down. It should have died, but they come back. They absorb it. Same thing here. You can see these candles. Each time that it fails, they end up absorbing it. So we were talking about this in the Traders Lounge, which is our sort of off-topic room to discuss tape and discuss situations like this. And so I was noting exactly that they're not letting this thing go. And as you can see, the next candle right there swiped up, and it was on 2.2 million shares. That's double the float. So now we have all these shares that are out there that are from shorts as well as traders, and there's limited quantities. So it continued to go and go and go, and as you can see, it basically squeezed everybody out before it finally started to come back in. So it was a very nice opportunity, but a great example of it should have pulled back. It should have stayed heavy, but it didn't. It did not give shorts that exit. So because of that, we start to have these very quick moves. People look at it and they think, well, this stock's up 100%, 200%. It has to go down. No, it doesn't. And it actually doubled basically off this 10 a.m. move. So, it went from a double from pre-market, faded back, doubled again, trapped again, and doubled again. And all along, the volume was continually flipping and flipping and flipping around, and shorts essentially were building positions, longs were keeping their positions, and as we talked about, it's just a matter of supply and demand. So that's a great example of a situation where it holds support, it's over VWAP, and the trend continues. Another situation would be on SCKT. And so SCKT has been quite a mover many, many, many times. But once again, we kind of throw in the looking left scenario, and we've got some situations here where it's ran, but it doesn't break over prior resistance points. So in this case, you can see that we've got some resistance here at 430s, and we'll take a look at the daily chart in a moment. But in a situation like this, it comes into resistance, and you can see how it blows off every single time. And then when it finally cracks under that support. So you can see that there's pretty much a channel here. And then there's support right here. Let's just call it 350 range, 350, 355. And let's call, this right around here, 415, 420. So it's essentially stuck in this channel. So what you want to see in a situation like this is, even though the float has rotated, even though, shorts may be in a bind, all that matters is if you're over this channel, if you're over towards the highs. If it breaks under that, and you can see here where it slams down, then it comes back and retests, and it fails. And so that was the tell that that move was done. Whereas, as you saw with the other ones, in this situation, when it had the big fail, it actually would come back. And then when it started to base over the prior resistance, that's when it squeezed. And that's the difference between if there's too much inventory, even though there's a lot of demand, sometimes, in some instances, It doesn't matter if the float flips if the trend is not in agreement. So keep in mind that float rotation is not just that the float has flipped, that the float has gone 2, 3, 4, 10 times what the float is. All that matters is if you're holding trend. And if you're not, don't fight it. So a couple examples on charts. I'll go through a bunch of different ones and then I'll kind of bring it all back together. But one of the best examples that I could probably come up with, you guys probably remember back in the day, Dry Ships, DRYS. That was one of the first of its kind where it's a very, very thin float. And then it takes off like crazy. Another thin float one would be SPI, which is around 1 million, 2 million float at the time. That went obviously nuts from basically 3 to 4 to 5 all the way up to basically 45 the very next day. That was another crazy situation. We've had numerous ones this year, but one of the craziest ones that was not a super thin float was Kodak, which just started to compound over itself and had one of the craziest runs and moves that I've ever seen or participated in. So this is the type of situations that I'm talking about. Just to fly through a few other examples, GTEC most recently, about 170 million shares traded. You know, why that day? What could you have seen to have potentially traded that? MRIN is another example where, you know, a relatively thin name, all of a sudden it trades, 170 million shares of stock. EVK, very similar situation, and this one traded 150 million shares. We have these types of things happening every single day, but the key is to understand which ones have the potential for, the really big moves, and then which ones have the potential for big fades. So obviously meds you can see here, SCKT is another one, as well as MDGS. All three of these you can see have huge volume, but they did not really go anywhere. So one of the key concepts that we talk about all the time is looking left. We have plenty of videos on this. I would highly suggest you guys take a look at them. Since I've already done videos on them, I'm not going to spend time on that tonight. However, if you look at prior resistance and prior levels that it's had trouble with in the past, you can safely assume that it's going to have trouble with them again until it proves otherwise. And the way in which it proves otherwise is when it starts to compound the volume over and over and over again, and then break through those levels and start to base and then continue on. And that's exactly what we saw in a situation like GTech, which, as you can see, looks just like, an MDGS or an SCKT, where, it's running into resistance, but this time it powered through. So yeah, it hit a wall. It hit a wall at 350 and 4, and it failed a few times, but then the volume continually churned and churned and churned, and then guess what? It broke through. And that is the key. That is the point that I was making earlier, where you need to pay attention to the volume. And if you're tracking for a super, super high volume day and the trend does not fail where it should, right? So in this case, we could safely assume that 4 should give it trouble, and then maybe 450 should definitely give it trouble. If all of a sudden it starts to break out and hold over 450 and it starts going to 470, it starts going to 5, that is the type of trade that could potentially really, really go. So that's a perfect example of that. Another one most recently was AHT. So AHT actually had another big move recently. And it's been a stock that's pretty much just come straight down. It's failed multiple times. Each time it kind of tries to rebound, it's had a tough time. However, we finally had some big volume just recently, and you can see that the first time it rebounded, it had trouble with this particular top, which happens to be the prior support level. So sometimes that support level becomes resistance. That's exactly what happened in this case. So that particular volume day was about 12 million shares. The next highest volume day was about 9 million. All of a sudden, we're here and we're almost 100 million shares. So typically what I do is I look left. I look at the float, number one, and then I look at the highest volume day. And we're tracking for way over that volume. We're tracking for more than the float. And all of a sudden, we're over those key levels. We have a major outlier breakout day. And that is what I am interested in. So that's another great example of a potential that has, that staying power. Another one that I had talked about was Kodak. Kodak was one of those situations where it actually went into a bunch of different circuit halts. So if you were short, there really wasn't much you could do. It was a very difficult situation. It's not anything that I've seen before. It is one of the first of its kind. Another example is IMAC recently. Understanding, again, I don't want to get into the looking left situation, but you can kind of see this situation like we talk about and why you should assume 250 fails. Had it continued to track for crazy volume and based over 250s, you have a potential, but you should always assume that it's not going to. So APVO, you've got a big situation here where you came over that prior high and you ended up coming back, reconfirming over that level, and then you've got a potential breakout. So this was another big example of, a day that, or a trade that typically, like I said, does, 50,000, 20,000, 8,000, 100,000 per day. And then all of a sudden, guess what? It's trading 40 million shares on any particular day, 30 million, and it takes off. So let's do a couple more just to kind of give you a few examples. The UONE was a big one. And so this was about a 1 million share float. And it was a day that it just kind of took off. And this particular day had 25 million shares. So that move wasn't even, that big, right? So it went from about $2 to $8 that day. And then it came back to about $6. That next morning, it dipped down a little bit and it held on to that prior day's close and then continued to go. So this was a situation where there was 1 million shares available, right? So there's 1 million shares in the float and it traded 25 million shares. So the float flipped over 25 different times. So if you think about doing the math on 1 million shares, divide that out by 25 million shares, you can start to see how, if you start to fight this trade as a short seller, and then you divide it all out by 25 million shares and how dispersed those shares likely are, if you have too much on the wrong side, you're going to get ran over. And that's exactly what happened. And, the stock ended up going all the way up to about 40 the next day, continued to squeeze out all the way up to about 50, 55 the following week. But it was a very unique situation. And once again, the next day it traded 45 million shares. So again, going off that 1 million shares, you've now traded 45 plus 25, right? So you're 70 times the float within 2 days has traded. And so anybody that looks at the volume and thinks, oh, this is pretty liquid, I can trade, 5,000, 10,000 shares very easily. Sure, you can, but don't be alarmed when the swipe comes in and it moves, $1, $2, $5 against you. So the key again is, understanding which day has the potential and what are the signs to potentially, join it, of course, but also what to be aware of on the short side so that you don't get ran over. So in this particular example, in these particular examples, rather, I think that it is most important to focus on the pre-market volume, what it's tracking for. Anytime that it is tracking for over the float or, somewhere around that, you need to be super, super cautious. If it is tracking for less than the float, and it's a big gap and it fails into prior resistance, then you have a potential fade. However, if the volume continues to churn throughout the day and price holds, that's when your antenna should go up. And just like I said, ACB is a great example of, these things don't need to have super, super thin floats, right? In this case, I think ACB, I will actually double check right now, but if I were to take a look at ACB, I think it's in the 100 million share range, 160 million float on ACB, but we ended up trading almost 4 times that, 461 million shares that day. So that is why you got the outlier range, is because you had almost 4 times the float trade. And even though, it was 160 million shares versus something like UONE, which is only 1 million, people make decisions because they feel safe. Hey, this thing's a really, really thick name. There's no way that this can do that. And then it does. And that is 2020. And that is why we have to be careful out there. One of the other things that I look for when anticipating what could happen on a particular move is the ease of borrow. So, for example, what clearing firms have availability, and at what capacity, or did it need to be borrowed, and what was the price? So I'll give you a couple examples. When I'm looking to trade a particular name and it's easy to borrow at every single clearing firm that I have, my antenna goes up because that means that there's a good chance that everybody could short it. That means that the supply is, very much available. Whereas if it was a harder to borrow, maybe it's a thinner name, lower float type stock that we've kind of been talking about, and then I actually have to go and try to locate the stock and say it's a penny or two per share. Okay, well then I think about it in a different manner. At least there's a barrier to entry in order to short the stock. And then I can take it one step further and I go in for a little bit of stock. I get it. I go back for some more. There's none. And I only was able to get a couple thousand shares, 10,000 shares, whatever the number may be. But scarcity. There's only so much available. And if I know that I have the best broker, the best clearing firm, the best options in order to locate a particular stock, then how many other people are going to find stock to be able to short? There's not a very good chance. So therefore, the way that my antenna goes up in that case is, well, if it does start to go and it starts to look really, really good and it looks like a squeeze, realistically, who are they going to squeeze? Right? If nobody can borrow the stock, then who is left for them to squeeze? And that is what I think about in a situation like that. So I always look at the ease of borrow, how much it was to borrow, or how scarce it is. And that really plays into decision making and what I can and will do on a particular name. And it helps me form my bias. Another thing that you want to think about is what type of trading environment are you currently in, right? So electric vehicles, insanity recently. And do you want to step in front of an electric vehicle style name? Probably not. And you want to think about those types of situations. If you've got a ticker like NIO, NIO, has been running up like crazy lately. And then you've got something like XPEV and LI that are also running on the heels of NIO. You need to understand the buying temperature of traders, the how excitable are they? They just saw NIO literally double and then double again. And now they can get in for a very low price on this particular stock, and they're going to hold it. You don't want to step in front of these trades, these types of situations when buying temperature is extremely hot. The next step of this particular kind of situation is, in the event that there was a ton of stock available to borrow, in the event that, the trend held, let's talk about it in a couple more days, right? So stock ran, people got short, pulled back a little bit, but the price held. The price is held for a couple days. And now we're on T+2, which is a typical settlement. And so on day 2 and day 3 of the move, you might actually start to see that trend picking back up. So in a situation like this, if we had 100 million shares and then it just dies off to about 5 million shares the next day, but the price held, the next day it starts to go and there's only 100 or 200,000 shares on the tape, there is a very good chance that we could have a nice short squeeze. So that is another thing that I look for in these types of situations. Ease of borrow, how likely are the traders to remain short, right? Was it a nice and easy short, but there wasn't really an exit yet? If there wasn't really an exit yet and the price is holding, then there is a good chance that we could go on for the next breakout. And that's exactly what happened on the AHT example that I just showed you on the last piece. One of the craziest changes in 2020 is the number of circuit halts. Circuit halts, essentially, the design is that, if a press release came out and a stock ripped, 10% real fast, the market would pause the stock for a moment, allow people to actually digest whatever press release just came out, read through it, get a feel, be able to base their decision, wisely, based off of, reading the headline or the press release, and rather than just kind of react on emotion. What it's actually turned into is almost like a manipulative tool where if there is a lot of volume, then sometimes you might get into a situation where shorts are on the wrong side, and I'll use they know that, and in this sense, it would be market participants in a large capacity, maybe very, very long, know or at least sense that shorts are bent, and it might be worthwhile to basically shove it into a circuit halt, move it up into a circuit halt, create that fear, that panic, that unknown of where this could potentially go. And now if you're short, you're thinking, oh no, how much am I going to lose? And you start acting emotionally. And anytime that it circuit halts, sometimes it opens higher, sometimes it opens around the same. But what happens many times, it might go right into another one. And so you either are part of the opening print where you could put in your order ahead of time and participate in that auction. 2, you let it open up and it potentially pulls back a little bit and hopefully you get a fill. Or 3, you see it pull back a little bit. You think that it's going to come back. You think it's going to pull back. It starts to pull back and then all of a sudden it swipes up and you're right back into the next circuit halt up, and you still have your position. So there's 3 different scenarios there, and there really isn't a good way to go about it. It's horrible. It's not fun when you get stuck in a circuit halt, which is why it's so important to make sure that you size correctly on names, and it's so important not to fight the trend. And when you are wrong, make sure you're wrong, because this, in my opinion, would probably be the most incredible short squeeze that I've seen in my time. Not necessarily the biggest as far as price, but the biggest in the sense of how much volume and how much size actually traded. And in this particular case, it basically ramped up to about 25. It went into a circuit halt. It opened off that circuit halt, and it paused for a few moments. It looked like it was going to fade. All of a sudden, it went straight into the next circuit halt. And at that point, everybody was upside down. It went into the next one, the next one, the next one. And what happens is you're not prepared for this, right? You might have money at home. You're not going to be able to convince your broker that, hey, it's a good idea to let me just be short and, hopefully it comes back in, because it's their exposure. It's the clearing firm's exposure. So all of a sudden you're faced with a situation that maybe you're oversized, you're on the wrong side of the trade, and if you don't get out properly right away, you might end up having a margin call. And by the time you finally fill, that's it. Everybody gets blown out. And then guess what? There's no buyers. And it completely unwinds. So it's a very difficult situation to be in, but it is how the game has changed in 2020. This is probably the most pronounced circuit halt that I've ever seen, in terms of how big they could get. But we also have this type of situation all the time. There are newsletters out there that literally use their following to basically force particular names into circuit halts, right? So, anytime that a stock ramps up into a circuit halt, people notice. So what's happened a lot is that there's a new kind of game in town for 2020 where people that actually run services and have, a lot of sheep following them, they will actually look for these types of situations and then actually try to forcibly push these things into circuit halts in order to create more and more interest and then potentially profit from it. So that is another thing that has been happening on these $2, $3, $5, $10 type stocks that you have to look out for. And the most important part that you as a trader need to anticipate or at least be aware of is, where does the tide change? Where does the momentum shift? And if you're not on the right side of that momentum, then you need to be cautious. And, that's as simple as drawing a line, looking at prior resistance levels, looking at prior support where it should have broke down, but it doesn't, ends up holding on. Looking, like I said, at the prior resistance levels. If all of a sudden it breaks through it, starts to consolidate over it, and starts to look like it's going to continue to break out, that is a perfect example of that. And it's not always things that are at your control, right? You might have been positioned properly. Maybe you were a little bit bigger than you should be, but if it reacts too quickly and ramps up too fast, you might hit a stop. You might have a margin call where, you don't have any choice but to get out. And it's unfortunate. It's part of trading. And this is really what you have to be aware of on these thin names that people like to manufacture moves on. So be cautious, be aware of it. That is what's new in this type of market in 2020. It's something that we didn't really have to worry about before. It's something that you didn't even really have to think about before. But now, at least when I'm trading, I start to think, okay, does this one have the potential of it? And am I prepared? Am I positioned correctly in the event that it actually does? And if not, then typically I either size down or wait for some type of better edge so that the risk could be better towards my side. So 2020 is literally the same stuff. It's just a different year. And what I mean by that is it's the same concepts. It's the same foundation that you need to use to trade. But things just look different. So, for example, instead of having a $100 million company, you've got a $1 billion company. Instead of $1 billion, it's $10 billion. Instead of $10 billion, it's, who knows? It's a $1 trillion company now. But, at the end of the day, it's the same chart setups. It's the same overextensions. It's the same bounce plays. Whatever type of trader you are, the same concepts apply. it just looks different. Same forces at play, but the game is a little bit different. And the way that it's different is instead of waking up and being lucky to have a 30 or a 50 or a 80% gap on a particular name to trade that day, we now have a handful of stocks that are up 80, 100, 150% every single day. And instead of having stocks with maybe a couple million shares, maybe 10, 20, 30 million on a good day, now we have numerous 100 million share names, as well as some that go into the 2, 3, 400 million shares traded on a particular day. It's insane volume, and it all comes down to supply and demand. And right now, there is just too much demand, not enough supply. Even when they add supply, there's so many different ways for them to potentially add shares through an offering, through different ways in which they can through their filings. And you know what? It just hasn't mattered in 2020 for the most part. Obviously, there's going to be some that are dilutive. Obviously, there's going to be some that, completely take people off guard and by surprise. But for the most part, I've seen an amazing number of offerings happen and the price stays. And it all comes down to supply and demand. And one thing that you need to be aware of, especially as a short seller, is right now there is no shortage for demand. So when the stock stops going in your favor, you need to take note and be aware. Now, one of my favorite concepts that I talk about literally every Sunday scan, as well as every day in the room, and on a couple recent videos that I've done on YouTube, is the concept of looking left. Looking left will always keep you safe. It will keep you rechecking in with your risk. It will keep you on the right side of the trade. All you have to do is look at prior support and resistance. You don't want to try to be a hero and try to find the top. You want to be part of the move down. You don't want to find the move down. You want to wait for all the early short sellers to exhaust out, just like if you're trying to find the bottom, right? If you're trying to find the bottom on a particular name, you want to wait until all the bounce players exhaust out. Once they try to find the bottom, and then they finally give up, at which point you may see a rebound, you still want to see support come in after that. You want to see a higher low. You want to see a level hold. And you will identify that after that washout comes, after that pullback comes, by looking left, looking at where it found prior support, and then using that as your guide to risk. So you always want to look left to have an understanding of where a potential stock could go, where it could potentially break out to, where it could run into resistance, or on the flip side, where it could fall to and where it might find support. So always be looking left. Always use that to help you out with positioning into a particular trade, or on the flip side, exiting properly. And just understand that the simpler you make trading, the easier it's going to be. Trading is not easy, but the harder you make it, the harder it's going to be. Try to simplify what you do, and I promise you, the simpler you make it, the easier it's going to get. So 2020, you could probably call it the year of the trader, right? It is the year that made many, many traders, that literally took them from excellent to unbelievable, and exponential returns. Things that I've never even thought were humanly possible. Returns that you would expect from 100, 200, 500 million fund, but being done by retail traders with retail money. Things like that are being done left and right, and not just by a few, by many. There's a lot of silent beasts out there that are just absolutely demolishing the market this year. And that can be you, but it's just about what you put into it. And the way that on the video that we did to promote this webinar, I said that I'm going to go over some examples to really 10x your process, really put it into high gear. And I think so much has to do with focusing on you. It's very important to not be influenced by everyone around you. There's pros and cons to social media. There's pros and cons to chat rooms. There's pros and cons to, being friends with people that are doing extremely well. Because what happens is somebody is always making more. No matter where you look, somebody's always going to make more. If you can understand that and be okay with it, you'll do just fine. But the problem is that we start to feel like we're underperforming. We start to feel like we need to step it up. It's good to review your trades and know where you could have done better. But most of us may just not be there yet, right? You need to feel comfortable in the trade. Anytime that you don't feel comfortable in the trade, you shouldn't be in it. If you are, you could size down. But you need to feel comfortable in your own shoes. You need to trade for yourself, and you need to get better than you were yesterday, than you were last week, than you were last month, than you were last year, right? That's what this is about. It's about focusing on what you as an individual can do better to make yourself maybe that 1% better each and every single day. And for me personally, I need to stay firing on all cylinders. When I'm firing on all cylinders, my returns are exponential. They start to compound and they start to go crazy. When I get away from that, when I start to get away from the process that got me there, when I start throwing in, darts into particular names and start oversizing and trying to play catch up with, a buddy who just had his biggest day ever, whatever it may be that's influencing you. Whenever I do that, guess what? I go backwards. And you know what that does? It takes you off from firing on all cylinders. And you know what that does? It stops you from compounding your returns. And so all of a sudden, you go from being at all-time highs, compounding your gains, doing a phenomenal job, to all of a sudden you're going backwards because somebody was making more. So understand that somebody is always making more. Be okay with it, get over it, deal with it, and move on. So this market is not going anywhere. Every single day there's something new. I think that traders are getting bigger and bigger and bigger. I think that funds and algorithms are figuring out new ways, and they're creating plays, they're creating liquidity, they're creating environments that not only can they trade in, but everyone can. And that's exactly what we have. So you need to find out what you're best at. And so I mentioned that sometimes it's as easy as not trading what you're poor at, right? So I'll give you an example for me. If I am trading low float names, 1, 2, 3 million shares, I have a max size that I'm going to trade on those. I don't want to get into a position that I'm outsized versus the float. I've been there before, whether it's on the wrong side of the trade or the right side of the trade. The thing is even if you're on the right side of the trade, all it takes is a candle or two, and all of a sudden your entire profit is gone, and then potentially more. So for me, I like to have kind of a max size on trades that I might be good at, but really bring out my weakness and my bias and my stubbornness as a trader. So that's one thing that I've changed. The other thing was the front side of the moves. I feel like I'm very good at anticipating when a trade may reverse. But in the event that I am wrong, I need to be wrong. In the past, I'm not always wrong right away. And so what happens is, even if it doesn't turn into a big loss, it brings your attention away from what you could be making money on. It brings your attention away from trades that you could be taking. And so, for the lack of a better word, maybe opportunity cost, right? While you were trying to figure out a particular trade and your energy and your focus was on that, what was the opportunity that you missed? So when I am trading my best, if a trade's not doing what I thought, I'm moving on. I'm out. And if a trade is doing what I thought, I'm scaling in. I'm adding to the position as it's working. And I am locking in as, the particular trade moves, I guess, more quickly in the anticipated direction. If I went out there and had a plan and thought that a trade could potentially fade or break out to a particular level, I need to trade that plan. Because what happens is, sometimes when a trade starts to go in the direction we anticipated, we just start to say, let's just kind of see what it does. But that wasn't the plan. So my goal is always to get the meat of the move on as much size that makes sense as possible, but not the whole move. Because a lot of times when I try to get the entire move, it ends up going backwards, right? So in my opinion, you should be focusing on what you're best at and then try to make that better each and every single day. You have a particular setup that you find success with. Ignore the rest. You can always build on other strategies later. But right now, especially with the way that the market is, you need to focus on what you're good at and keep on trying to compound that as best as you can and take as much as you can out of the market for this period of time before it cools down. Do we know when that will be? No. Personally, I don't see this thing slowing down for the next 2 or 3 years. I personally think that this is the new way. Electronic trading, algorithms, you name it. I think that they've figured out new ways to extract capital out of these markets, and I don't see this stuff going away anytime soon. So personally, I'm not worried about it, but we don't know. We don't know that. So when you have trades like this each and every single day, it's our job to capitalize on that, take advantage of that, and do what we're best at. If we focus on what we're best at and compound what we're best at, then that's a good process. And in the end, the better process you have, the better profits you're going to have at the end of the day. If you start to focus on profits, if you start to focus on chasing P&L, if you start chasing your best buddy who made a bunch of money yesterday, none of that has to do with the process. And therefore, it's going to backfire on you. Always focus on the process, and the process takes care of itself.
So this has pretty much always been the case, but is especially true in 2020. Day trading needs to be treated like a professional sport. It's a high-performance activity in a very competitive niche where fortunes can be made and lost in a very short period of time. Consider the way that Tom Brady approaches his craft. The physical and mental preparation, the training, the conditioning, the discipline, removing all distractions, the recovery process. Everything is lining up so when it's game day, he can perform at his very peak level, compete with the best, and come out on top. So I know that Nate looks to Tom Brady not as an idol or a mentor, but as an example of what it takes to be the very best. And if you're expecting to be an 8-figure-a-year elite trader, you need to have a similar process, similar methodology to other elite players in their own field. So all of these activities that you're doing prepare you for game day. And when you're looking at a 6-figure winner, but it's unrealized, and you're thinking, what should I do with this trade? Your mind is calm, your hands are steady, and you can make the right decisions to achieve the full potential of the opportunities presented to you. So at Investors Underground, we don't really care about being the biggest trading community in the world. All we care about is being the best. Now, this doesn't mean that you need to be an expert or a highly experienced trader to become part of the Investors Underground community. You know, some of the best traders I know today started off in Investors Underground with little experience or expertise. However, we are looking for the most dedicated traders. You don't need to be the best, but you do need to be the most dedicated. We invest a lot of energy and time into our Investors Underground members, and we want to see them achieve everything that they set out to, whether they're new traders getting started in the game and looking to expand their knowledge and experience, or whether they're expert traders who are looking to add a couple of tools to their trading tool belt. Investors Underground is the number one place for traders to get together, share ideas, learn from each other, post timely news and information, and excel in their field, while working towards being a peak performance athlete of the trading world. We understand that everybody coming into the world of trading starts with different budgets and different circumstances. So we often try and run sales and different promotions to help people come on board with a little cost relief. Because of the onboarding process and the energy and the effort that we put into our new members, we have to restrict the allocation of these positions to ensure that they get the top level experience and engagement that members are used to when they get involved with Investors Underground. If we were trying to be the biggest trading service in the world and onboard hundreds of members at a time, Investors Underground would risk losing its reputation as the top trading service because we wouldn't be able to deal with that kind of flow. The members' experience would deteriorate because it would be too much too quickly. So we've allocated 35 positions for people to be able to come on board at discounted rates to offer some cost relief from our everyday pricing. So I've got a link up on the screen now, www.investorsunderground.com/learn. Punch that in as a URL and you'll be able to see whether or not there are some allocations left at this discounted pricing. You know, you've probably learned something from this webinar. Only having access to myself and Nate for the last hour and a half. Imagine what we can do for your trading if you have access to what we're doing here. Not only myself and Nate, but also all of the other moderators and members of the Investors Underground community for a whole year. We're looking for dedicated individuals who are ready to make an investment in themselves so we can turn around and make an investment in you and take your trading to the next level. I've got a link up on the screen right now where you can go and check out these deals. I'm sure that the allocations will get taken quickly, but we have to restrict these to make sure that the quality of what we deliver at IU is never compromised. Thanks for making it to the end of this webinar. It's been great to have you all follow along. We want to see you in the Investors Underground community. Looking forward to making an introduction there.